Okay, now listen, I just spent about the last 2 weeks analyzing 100 real millionaire investment portfolios, and I found out something that completely contradicts what we've been told during our wealth building journey, okay? Now, the average millionaire portfolio I analyzed had just 6 holdings in it. 6, not 30 individual stocks, not a complex mix of crypto, REITs, and option strategies, just 6 simple investments. In fact, 73% of millionaires that I studied have fewer investments than the average Robinhood user. Here's what's even crazier. The simpler the portfolio, the wealthier the person. I'm calling this the inverse complexity rule, and today I'm going to show you exactly what I found, why it works, and how you can apply it to yourself. So let's dive in. Now, before I dive into the data, I want to ask you something. What do you think a multi-millionaire investment portfolio looks like? Because when you start getting to that upper tier of investing, I think most people are imagining 20 to 30 individual stock picks, active trading and market timing. As you continue improving, we're in the tens of millions of dollars. You've got exotic investments, crypto, private equity, alternative assets, complex strategies. They're looking at options, covers called. We're looking at sector rotations, constant monitoring and rebalancing of a portfolio, and just 100% in the market at all times digging into this stuff. And honestly, that's kind of what I thought too when I first started. And that's what social media influencers and people tend to want you to believe, because they want to sell you on a course. They want to be the next stock picking guru. They want to have all the answers to this stuff. But here is the reality to the situation. You see, most millionaires have portfolios that are almost always boring, shockingly simple, and that simplicity is a feature to all of them, and it's a commonality. So I decided to actually analyze about 100 real portfolios to see if this pattern held up. And here's how it did. Okay, now I pulled data from 3 different sources to get a real picture of all of this. First was the SEC 13F filings. Now, these are public filings from investors managing over $100 million. People like Warren Buffett, Bill Ackman, and many more. But there are also smaller institutional managers, people that you've never really heard of before. Now, source 2 was the Boglehead forum. This is self-reported millionaires that are sharing their actual portfolios, their verified net worth through detailed posts. They're real people, and they're not institutions. And then source 3 is published case studies. I got about 20 portfolios from that. Magazine interviews, books like The Millionaire Next Door, going into Reddit/Fatfire, things like that. Verified portfolios, public investor letters. Now, I categorized every holding and counted positions, calculated allocations, and looked up patterns. And what I found really surprised me. All right, so let's talk about the good stuff here. Let's get into the 5 key findings that we found from this experiment. So for the first thing is simplicity is key, okay? The average number of holdings across the 100 portfolio, I mentioned it before, just 6.3 different investments. Okay, breaking that down though, 28% had just 3 to 4 holdings, while 45% had 5 to 7 holdings, 21% had 8 to 10 holdings, and just 6% had more than 10. Now, go and check your Robinhood portfolio, whatever brokerage you're using, and I guarantee it's probably more than that. I know if I open mine up, I'm a victim to that as well. But this was research that really opened my eyes, because almost 3/4 of millionaires I analyzed own fewer than 8 different investments. That's just insane. When you compare that to the average retail investor on Robinhood who owns 10 to 15 different stocks, crypto, fractional shares of everything, meme stocks, whatever it is, there's just too much going on. Now, the second finding that I came across is that index funds absolutely dominate these. Okay, so of the 100 portfolios that I analyzed, 89%, a high B plus, almost an A minus, included at least one broad market index fund. We're talking VTI, VOO, VTSAX, or SPY. And the most common holdings that I found was Vanguard's Total Stock Market Index, VTI, or VTSAX, was in 61 different portfolios. The S&P 500 Index, VOO, SPY, VFIAX, was in 58 different portfolios. Vanguard's Total Bond Market was in 43 different portfolios, and international index funds were in 37 different portfolios. So nearly 90% of millionaires held boring, low-cost index funds as their foundation, not individual stocks, not crypto, not the next hot IPO. Basic, boring, but beautiful. Now, the third finding is that individual stocks are always secondary to these, okay? So when millionaires did own individual stocks, their average allocation was just 15 to 25% of their portfolio. And the average number of individual stocks was 3 to 5 for them. Not your typical 20 to 30 that you see online, just 3 to 5. Now, most common was companies that they actually worked for or deeply understood. Okay. And one Boglehead millionaire had 85% in VTSAX, 15% of the rest was just in 3 different stocks: Apple, Microsoft, and their employer. An SEC filer had 70% in the S&P 500 with 30% split between just 4 positions. We're talking Berkshire, Google, Amazon, and Visa. Now, they weren't avoiding individual stocks entirely. They just weren't making it overly complicated. Now, finding number 4 is something that I call the inverse complexity rule. Here's the pattern that I found that blew my mind. Okay, I plotted the net worth against portfolio complexity, meaning the number of holdings in each of the portfolios. And the trend, as net worth increases, portfolio complexity decreases. So those with under $1 million average just 8.2 holdings, 1 million to 3 million average 6.8 holdings, 3 million to 10 million average 5.1 holdings, and $10 million plus average 4.3 holdings. You see, the wealthier that the person is, the simpler their portfolio becomes. Why? Well, my theory after reading through discussions and just analyzing this data is that they learned that simplicity works. Complexity wasn't making them rich, so they stopped doing it altogether. They also realized that time is way more valuable, and this is something that I think could apply to most of us here. Okay, managing 50 different positions takes time away from earning more money. To them, it's just not worth it, right? You're also looking at lower costs minus fewer transaction, which is going to give you fewer taxes and fees. You're less emotional and you have fewer positions, which gives you fewer decisions and less stress overall. It just makes sense. Okay, so finding number 5, that was pretty interesting to me. What about some of the other stuff? What about crypto, REITs, and alternative investments? You see, only 23 portfolios included cryptocurrency with an average allocation of just 2 to 5%. Now, I personally think that's still a little bit low based off my own beliefs on cryptocurrency and where some of it's headed, like big, that's besides the fact, okay? Only 31% had separate REIT holdings, and many actually got exposure to real estate through index funds anyways. Private equity, hedge funds, gold was less than 15% of their portfolios. Now, most millionaires here aren't chasing the hottest new thing. They're just building wealth slowly through boring, proven assets. The ones that did have alternatives usually had a very small percentage. We're talking just 5 to 10%, or got wealthy from that asset. We're talking crypto millionaires, obviously hold crypto, but even crypto millionaires that I found often had 60 to 70% in traditional index funds for stability. They made all their money. It was a little bit risky. It got really hot. They got out and they go back to simplicity. And that seems to be the trend over and over. So with these 5 key findings, I do want to explain the inverse complexity rule and how to apply it. Okay, so the rule is beyond a certain point, adding complexity to your portfolio actually decreases the returns and increases stress without improving any of the outcomes for you. You see, research shows that there's a sweet spot. Too simple is 1 to 2 holdings. You might miss diversification benefits. Optimal is 3 to 8 holdings, which is the maximum benefit with minimum complexity. Then you get into the too complex category, which is like 15 plus holdings that has diminishing returns, higher costs, and just way more stress. And let's talk about the 3-tier millionaire framework, because based on my analysis, here's the pattern that most millionaires follow. Tier 1 is the foundation, which is 60 to 80% of the portfolio. You just get 1 to 2 broad market index funds. We're talking VTI or VOO. Maybe 1 bond fund if you're older or more conservative, and this is kind of your autopilot wealth builder. Now, tier 2 is the conviction layer, which is 10 to 30% of your portfolio. And this is where you select kind of 2 to 5 individual stocks that you deeply understand or a sector that you really believe in, tech, healthcare, whatever that might be. And this is where you can make calculated risks. And then tier 3 is the alternative slice, which is 0 to 10% of their portfolios, which you start getting into real estate, crypto, whatever interests you more. Small enough that it can't destroy you, but large enough to matter if it works. So you might be wondering, why doesn't anybody teach this? And I mean, think about it, right? Simplicity doesn't sell. Financial advisors can't charge you 1% to tell you to buy VTI. YouTube finance channels need more content. Let me tell you, just hold VOO doesn't make sense for 100 videos in a row. Trading apps profit from activity. They don't want you making just 2 trades per year. The finance industry needs you to believe that wealth is complex. And actually, you know what? There's a study from the University of California that found out financial complexity is often used just to justify fees. The more complex the strategy, the higher the fees, even when simpler strategies way outperform. But the millionaires that I studied, well, they figured it out. Complexity is expensive. It's time consuming and it's usually unnecessary. You see, they got rich by a few different things. They earned good income. They were saving consistently, investing in simple, low-cost funds. They were staying invested over decades, and they didn't mess with it. That's it. That's the pattern that they kept running into. And so you might be wondering what the action plan with all this. What should you do next? Now, I'm not a financial advisor. Again, I can't tell you exactly what to do, but I'll share what I personally did. So what I did was I discovered that I had well more than 15 holdings. I found out that it was overcomplicated, and here's how I simplified it. I listed everything that I owned, and I asked the question, why did I own this? And if the answer was, I don't really remember, or just because, well, I considered selling it. I consolidated down to 5 to 8 holdings. Right now, there's actually 8 in my main investment portfolio, and I accepted that I might be having FOMO on some other categories, but it's not really something that I need to lose sleep over. Now, if you're starting from scratch, I would use the 3-tier framework. Okay, start with tier 1, 80 to 100%. When you're starting out, I think that this is most viable. You need the foundation. Choose one broad market index fund, VOO, VTI, something like that. If you want dividends investments, you can mix some of that stuff in, like through SCHD or something like that, but ignore this stuff for years. Okay, later you can add tier 2, maybe when you have a portfolio value of like 50K or more. I don't know. This is just kind of spitballing. Again, not a financial advisor, but I'd pick 2 to 4 individual stocks that you really understood, not just stocks that you heard about, companies that you've researched, and I'd keep it under 25% of my portfolio. Now, tier 3, when I had like 100K or more in that portfolio, and only if I was genuinely interested, I would try to keep it under 10%. I would go into things like crypto or like some of the alternative assets that I was interested in, and I would think of it as learning money. Okay. And I don't want to be somebody who ignores crypto altogether. I've been building that alongside of my portfolio for some time now, but it's not going to really be over 10% of my total net worth unless it keeps skyrocketing the price of it, in which case it could overtake that pretty easily, but we'll see what happens in the future. Now, I'd just say stop trying to beat these millionaires. You want to become one of them. Stop trying to beat them with complexity. Join them with simplicity. And listen, after analyzing 100 portfolios, the common thread wasn't intelligence or secret strategies or perfect timing. It was consistency with a simple plan over a long period of time. That's it. That's the entire secret. Now, if you want to see how I rebalanced my entire portfolio earlier this year, and this was all taken into account for that, check out this video right here. Anyways, appreciate you. Hopefully you enjoyed this video. If you took something away, if you learned something, leave a comment down below, leave a like on the video. It means a lot. Thanks for checking it out, and have a great day.